Hello, it's Sunday, the 12th of October, 2025. I'm Jason Shapiro with crowdmarketreport.com. Today I wanted to talk about LTCM, long-term capital management. And I've probably talked about this before, but I think it's apropos, given what happened in the crypto market this past week. For those who don't know, LTCM was a large, very successful hedge fund in the late 90s. And it was run by what people would refer to as the masters of the universe, the smartest people out there, mathematicians, statisticians, and they were putting on mathematically pretty much what seemed like mathematically guaranteed trade, arbitrage type of trades. And they were doing very, very well doing that. And of course, with these type of trades, they're making a very small amount. But when you're the masters of the universe and you are making very, very steady money and doing it in size, you get to convince your brokerage houses to let you lever up so that if you're making a small amount of money on these trades, you can actually make a very big amount of money by the use of leverage. And why not? It's a guaranteed mathematical trade, nothing to lose, so why not lever up? And why wouldn't the banks let them lever up? So what happened with them was they had this trade on. It was before the euro came into existence, but the euro was coming into existence. And if the euro came into existence, then all of the interest rates, by definition, across Europe would have to converge to be the same thing, since they were all going to be under the same currency. So there was an arb opportunity. If, and I don't remember exactly what it was, but let's say if Italian interest rates were at 8 and Spanish interest rates were at 5, you could sell those Italian interest rates at 8, buy the Spanish interest rates at 5, and as long as the euro came into being, those interest rates would converge and you would make that free arbitrage money. And that's what these guys were doing in size, because they were convinced that the euro was going to come into existence. So why not just go big on it? That's what they did. While that was going on, there was another trade going on in the Russian ruble, where you could basically take your US dollars, turn them into rubles. You could borrow US dollars. Again, I'm making up the numbers, but it was like you could borrow US dollars, let's say 6%, roll them into rubles, and make 10%. And usually when that happens, then you do it for a year, and then you sell your rubles a year forward, and the discount you're getting arbs out that extra 5% interest rate. But in this case, it didn't. So you could sell those rubles forward in a year, and you could make that extra interest, and it was free arb. So they were doing that trade as well. What they missed on that one was that the counterparties in that trade were the Russian banks, and the Russian banks went belly up. They went out of business. They went bankrupt. So what they thought they had a counterparty on these trades, they didn't. So they were screwed. And what did they have to do? They had to meet margin. And where could they get the money to meet that margin? They had to get rid of this European trade. But here's the issue. They had such a large amount of it on, and not only did they, but let's not forget, those guys came out of Salomon Brothers, which at the time was arguably the most powerful trading force on Wall Street. Well, they left Salomon Brothers to start LTCM, but people in Salomon Brothers stayed and took those positions and were doing the same type of trades. And other banks had seen what Salomon Brothers are doing. I mean, this is the efficiency of markets, and we're hiring the other Salomon Brothers guys, so it was being done on other banks too, and they were all doing it on margin. So when it came time to liquidate, there was nobody left to buy, right? So they got screwed, and they blew up. And they went out of business. Not only did LTCM go out of business, but Salomon Brothers went out of business. Okay, which again at the time, it's like saying Goldman Sachs went out of business, right? Salomon at the time was the powerhouse. It's like saying Citadel went out of business, right? And that's how LTCM blew up. And the important part to remember here is that the euro did come into existence. They were right. The interest rates in the European interest rates did converge. They were right. These people blew out on a trade that was 100% correct, right? And they blew out simply because too much leverage, right? That was it. And too crowded. The trade was too crowded. Not just them, but all these other people had it on as well. And that's the lesson here, right? And that's kind of maybe similar to what just happened in crypto. You know, people just got blown out in crypto. And you can come up with a million reasons why it was. There was manipulation, there was this, there was that. But at the end of the day, people just had too much leverage, right? And it wasn't even like a mathematical guarantee. It was the same type of thought process. They didn't think crypto could ever go down. You know, fiat currencies were garbage. Crypto was only going to go up and all this. And to me, that was a false hope to begin with. You know, I mean, a lot of these people are in these, what they call meme coins, what I call things that have no intrinsic value and eventually have to go to zero. Either way, they were too levered. They all had to get out at the same time. There was no one to take the other side. The thing went offered only. It blew people out. And that's how it happens. And this happens a lot over time in the markets. If you do this long enough, you realize that this happens. And, you know, I get a lot of heat sometimes, even from people who enjoy being members of our Discord and everything and enjoy my thing. I get some heat that I don't put on enough trades. I undertrade. That I don't lever enough because my P&L is real good. Why wouldn't I lever more? And this is why, okay? If you can't be happy making compounding money at 15, 18, 20% a year over time, then you're doing it wrong. Because if you try to lever that up, yeah, I make 15% a year with a 4% drawdown. Well, I could lever that up 10 times. And on a 40% draw, I make 150% a year. Hooray. But every once in a while, something happens that comes around. And it always happens when you least expect it, by the way. By definition, right? Something comes around that will blow you out if you're that levered. I've learned that lesson in my life. I won't learn that lesson again. Okay? And this is one of the main messages I try to push to our people. It's not about how much money you make. It's about how much money you keep. Okay, anybody can make 200% in a bull market by levering up ridiculously, but you're going to give it back. It's going to happen. People don't believe me. I didn't believe it when I was young. I figured I was a genius and I could do that all the time until I learned. Okay, and I learned by blowing out. This is how it works. And no one I always say, I know you're not going to listen to me. I know if you're 24 years old and you made 200% last year in your crypto holdings or whatever, you're not going to listen to me. You're going to say, okay, boomer, right? Okay, boomer. Good. Welcome to okay, boomer is what I'm saying. This is how markets work. It's not the first time something like this happens. Like I say, it's not just some 20-year-old kid leveraging into some garbage crypto. The biggest geniuses in Wall Street in the late 90s fell victim to the same exact trap. Guaranteed trade in their mind, which actually ended up being so. So lever the hell out of it. Nothing can go wrong. Well, something always goes wrong along the way when that's the process. And you blow out. And when you blow out, that's it. You're done. You can't come back. I've done a video before that talks about how, blowing out or shorting S&P at one point in my life, it took 10 years away from me. At least away from my financial growth. And it's the same thing. If you blow out, you can't get it back because you're gone. You got zero, right? And that lesson is hard to know until it happens. I'm telling you that that's what happens. You don't want to trust me, that's fine. We're seeing some evidence that in fact does happen. We just saw some evidence that does in fact happen. So that's all I can really say. You have to not be so greedy, right? Because it will kill you. And if you're not around, you can't make any money, right? You have to stay alive. I always like to say you have to stay alive long enough so that you can get lucky, right? Once you're dead, you're dead. So that's the lesson. All right. I hope that hits home with people. Because if it doesn't, like I always say, it will eventually. And for a bunch of people last week, it did hit home eventually in an unfortunate way. So anyway, that's all I got to say. And we will talk again soon. Thank you. Hi, I just wanted to say if you like daily videos, we do them 4 days a week, Monday through Thursday, for people, and it costs, $10 a month. And I try to include a lot of other lessons as I go through, as you see in the daily videos as well. For that $10 a month, you also get our COT charts on equity indices and crypto. So if you think that's worth it, give it a shot. All right. And we hope to see you there. Thanks.